Hey guys, Akil Stokes here, and welcome back to another episode of the Trading Edge Weekend Edition. In today's video, I want to take a look at the difference between how I approach both trend continuation and counter trend trading setups. If you're brand new to the channel, make sure you subscribe. And of course, let me get the intro and the disclaimer out the way, and I'll see you guys in a few seconds. Hey traders, my name is Akil Stokes and welcome back to a weekend edition of the Trading Edge video. If you guys are new, I am a trader and a trading coach, co-founder of Tier1Trading.com, host of the Trading Coach podcast as well, one of the fastest growing Forex related podcasts out there. And this is a daily video that my trading partner and business partner, Jason Greystone, put out to our Tier 1 members on a daily basis, giving you an idea of what's on our radar for the day ahead. If you can believe it or not, I got criticized in my last video for welcoming you guys and giving you guys an introduction. And I know it may be boring for you guys that tune in each and every week. Thank you, by the way. But please understand that each and every week, we also have brand new traders that are finding this video. And I do think it's important that I introduce myself and tell them what to expect. Now, in today's video, we're going to take a look at a few setups. We're going to take a look at a trading setup here on the Canada yen. We're also going to take a trading setup or look at a trading setup over on the pound yen as well. And hopefully I can give you a well-rounded episode where we're looking at different types of ways to attack the market. And I wanted to start with the Canada yen and really a Canadian pair specifically because it follows up on a very interesting topic. And I get this each and every time we see a major fundamental release. And this past week, we had an interest rate hike in the US for the US dollar. And if you guys are watching the market live, we have seen some dollar strength after the fact. But if you're watching the market live during the interest rate decision at 2 p.m., you would have noticed that despite the hike of an interest rate, we saw a decline in the dollar. And if you're kind of just by the book with economics, you're probably freaking out and trying to figure out what's happening, right? Interest rate hike should mean strength for that currency. Why is the market going backwards? And unfortunately, there are a lot of traders that, well, they try to be cute and they try to trade that setup and they end up getting burnt. And typically when they end up getting burnt, I get an email or a message saying, hey, Akil, I tried to do this and I lost all my money. What happened? And you have to understand that the market doesn't move necessarily because of the news. Sometimes it does if there's any type of deviation, I should say, from the news. So if the market expects really good news and really bad news comes out, you're going to see movement or vice versa. But in the case of the interest rate hike here in the US, that had been priced into the market for a long time. We already knew it was happening. We knew it was happening for a very, very long time. So the market wasn't necessarily looking at that news event. They were looking past it for future clues. So the interest rate hike was expected. What the market was paying attention to was Fed Chair Jerome Powell's statement afterwards, seeing how optimistic or how hawkish or dovish we were about the future of interest rate hikes here in the US. And Canada is a great example. If you're looking on your chart right here, you see that we ended the week with a very big high momentum bullish candle. That's going to be that, if I zoom in my chart a little bit, that's going to be that big green candle at the far right of your screen, this bad boy right up here. And that came from a very good, and I would say somewhat surprising GDP announcement from the Canadian dollar, right? And here's how it affects the market. I don't mean to get too much into the fundamental side, but I think it is worth knowing, right? Recently, Canada had been in an interest rate hiking cycle. So they've been in a cycle where they were hiking rates. Then they took a pause, right? The trade war happened. They had some other issues that were going on with their economy. And they said, let's kind of pause for a second. Let's sit back and reevaluate. The positive number in GDP, right, the faster growing GDP is a positive sign that the Bank of Canada will continue with that interest rate hiking cycle. And I think October is the next chance they get to do it. So by the market reacting to this news, it's positioning itself for the next interest rate hike. So when the next interest rate hike comes, don't be surprised if all of the movement has already been priced into the market and there's really nowhere left to go but in the opposite direction. Now, and you can combine the fundamentals and the technicals together. We actually did a great session last week going back to my investment days, right? Long time ago, where we talked about using the fundamentals and then switching over to the technicals to find trading opportunities. But you can use that here as well. But technically speaking, right, we get back to the bread and butter, right? Because I am a technical trader. I believe in it first and foremost over everything. Back to the basics from a technical standpoint. We've recently had a higher high, higher close, and this is going to be a process called the IPDe process. Identify, predict, decide, execute. I know I sound like a broken record for you guys that are tuning in each and every week, for you guys that are on the Tier 1 trading platform, and you see this each and every day in both the London and the New York live room. But if we can ingrain this process into your head, if we can ingrain this ritual into your head, if we can allow you to become consistent with repeating this each and every time you look at a price chart, then we're doing our jobs and it will benefit you. I remember my trading mentor was Jason Stapleton, and he always used to say, look left, structure leaves clues. He would say it every day, and I'm like, man, if this guy doesn't stop saying that dumb stuff, I'm going to sleep thinking about it, I'm waking up, I'm seeing stuff in the street. But lo and behold, it was ingrained in my mind. I do it every time, and it allowed me to become a much better trader. So the stuff works, even if it seems boring or repetitive. But if we go through that process, IPDe, identify, predict, decide, execute, we can identify that price action has recently put in a high momentum bullish move that has broken and closed, right, violated our previous structure high. Now, identifying that we have violated our previous structure high allows us to make the prediction that price is likely to go higher. Now, the question that we ask ourselves is, if price is likely to go higher, then where is price likely to go higher to? And this is when we look left, structure leaves clues. We can also use the help if I just reload my chart real quick, because it's the weekend. I got a lot of data loaded up. If I just reload my chart real quick, let's just go down to a 4-hour chart. That'll make it a little easier. If we just reload my chart a little bit, we put on what's called our VS1 levels. I'm going to give myself a little bit more data just so you guys can see. I'm on the home computer today, not in the office. For you guys that have been following me, I had a little injury, kind of dislocated my knee again. So going up 5 flights of stairs to the city office isn't in the. My doctor said I shouldn't do it, so I'm gonna. And my wife, more importantly, said I shouldn't do it, so I'm trying to stay away from that. So my charts aren't loaded up the same way that they are at the office, but we'll try our best here. Anyway, if we look left, we can see structure leaves clues. If you're not familiar with, if you're not practiced and as skilled as you want to be on reading structure, a great indicator that you guys can use is called our VS1 indicator. It's a visual structure recognition indicator, which prints these pretty boxes. You can see blue on the top and red on the bottom. Should probably have those colors reversed, but again, not my default system here. And what they do is they give you a visual representation of what structure levels we need to pay attention to. So for you guys that are on the Tier 1 platform, whether you are a trial member, right, taking up that 14-day trial, or you're a premium member, you have access to this. Use it, use it, use it. Help with your structure recognition until you get good enough to kind of do it on your own. So looking left, this beautiful blue box here, this is the next level that I would predict price action is going to go to. And does that mean that there's a trading opportunity right now? No, right? If this were Sunday evening and the market opened right now, I would do absolutely nothing. But what it allows me to do is it allows me to set up my trading week. And when I do my analysis, my weekend analysis, this is typically what I'm trying to do. I'm trying to scan through the charts. I'm trying to filter out the pairs that have potential trading opportunities. And I'm basically game planning for the week. If you go back on my YouTube channel here, there's I think it's like an hour-long video I called how to do weekend analysis, something with weekend analysis, but I take you through kind of a full version of what I look for over the weekend. And what I do is this, right? Man, I got another plug for you. This is another freebie, so it's not really a plug. Go back to another video. I forgot what it's called, but we also give away our free pre-market checklist, which is a checklist that you can use if you guys want to be a little bit more organized with what levels you're looking for. But what I want to do is I want to identify this level. And again, this is where I'm predicting price action to go to. I'm predicting price action to go to this level up here, the 89 level, right? So I know that if the market opens, that's the wrong tool here. What am I looking for, Akil? I'm looking for my regular box rectangle. There we go, F12. That means if the market opens as a day trader, right? So going down to the lower time frames, as a day trader, I can immediately look for opportunities to hop on a bullish trend from where we're currently at 88.05 all the way to about 89 even, and that's about a 100 pip move. And that means going down to the lower time frames. For you guys that saw how we work on the 5-minute charts and range bar charts, those are those opportunities. For a swing trader, there's still opportunity as well. It's going to be a little bit different. I'm not particularly interested in buying right here because there's really no place I can be safe with stops. So what I would be looking for from a higher time frame perspective is some type of retracement and then looking for a continuation up. And it may not just be a retracement. We don't know what's going to happen until it happens. We could put in, say, like a high and tight flag pattern, which would be a breakout setup. But the point is, we're looking for some type of structure to be created. We're looking for a little bit of either relief or pause in the market and a signal to get long. Not only a signal to get long, but a signal to get long that allows us to place a safe stop loss. That way, we're not in a position where we have too much exposure to the market. So those are two ways I would look to handle this situation. Again, as a higher time frame trader, one, look for the pullback into structure, maybe 87.50s, and then the retreat or the extension higher to that ultimate 89 even destination. Two, you can look for some type of consolidation. Maybe we see a pennant pattern, a flag pattern, a triangle pattern, who knows what, some type of breakout pattern, and we can look at it from a breakout trading perspective. Or if you're a day trader, lower time frame trader, eyeball this right away, look for kind of smaller retracements and areas of relief on the lower time frame, and then look to take advantage of the continued move up. I would expect we get some relief though. Typically when you see a big move that is followed by some profit taking, a little bit of slowing in momentum before the next wave comes in. Now, if you are a longer time frame trader, a pattern trader, if we go up to the daily, just want to remind you guys of something. We also have a potential advanced pattern formation forming here. We're going to have a potential bat pattern forming, right? We're going to have an X leg that starts all the way up here, about 91.60s. That's going to be our swing high to swing low, our X to A. We then have an A to B move, right? Coming to the level between our 50% retracement and our 618 Fibonacci retracement. That's what this zone is, right here. You can see at the top it says bat or cipher. This is our one of our pattern recognition softwares, by the way. We then have a C leg, and for a bat pattern completion, we would expect price action to come to our 886 Fibonacci retracement taken from our initial swing, which is going to give you a bat pattern, a bearish bat pattern up at 90.32. So if you're a longer term trader, if you're a pattern trader, you can look to take advantage of that as well. Now, speaking of patterns, let's head over to the pound yen. This is a pair that's going to offer two potential advanced pattern formations. All right, this is a little bit of a review, but there is a second one that has occurred as well for you guys that watched the daily video. And let's just go down to the 4-hour chart here. Well, I guess first of all, on the daily, you can get some perspective of where we're at on the pound. And this is important because we're at a sneaky level. We've recently tested previous structure resistance looking left. That level of resistance held, right? We had a wacky week for the pound. We got a lot of news coming out, especially Brexit related stuff that always sends this pair bonkers. But you can see we spiked all the way up, and then immediately the next day, right, we tried to penetrate these highs. We saw some selling pressure, got rejected. We put in an engulfing candle all the way back down. And then the 2 following days after that, we basically made up for all those losses, and now we're trading right in the middle. So overall, we're not at an area that I care about. I tend to look at the swings of the market, the highs and the lows, and what happens in the middle, I just wait because it just doesn't fit my trading style. But when we do see consolidation, we often see advanced pattern formations form. So that's what we're going to be looking at for. But anyway, we want to pay attention to this level, but a sneaky second level, right? Going back to last video, right? Lessons I've learned from being a loser. This is why you guys got to watch this each and every week. You got to pay attention, right? Because these lessons do build on each other, not specifically in a way of like a training course, but they do build on each other as far as taking one concept and then relating that to the next opportunity. But you can see that there's a little bit there's a little higher area of resistance right up here around the 150 even handle. You do want to pay attention to that for stop loss placement, because if you put your stop loss right below it, you're just at a much riskier position. But going down to the 60-minute chart, the hourly, what we have is we have two, right? The deuce, two potential advanced pattern formations setting up. I'm going to kibosh my VS1s real quick, bring on my pattern recognition software, and we're going to see our first one looks like this, right? X to A, swing high to swing low, A to B. You want to check this, right? My rules are if our B leg hits the 786, then it is no longer a Gartley, and I'd be looking for butterflies. However, so you want to check to make sure it hits it. I have a move to the 77.7 level, so just underneath it. And I know that a lot of traders out there, a lot of educators out there, they teach and preach a close enough rule, meaning if it's close enough to this, close enough to that, then it counts. I have nothing wrong with that rule, but you want to make it rules-based. My rules are specific. Either it hits a level or it doesn't. It's black or white, one or the other. I don't want to give myself room to think, because if I give myself room to think, I'm going to really do what I want to do. If I want to see this as a Gartley, it's going to be a Gartley. If I don't, it's going to be, didn't actually get close enough, right? And we want to kind of take that away from our trading, because, you know, we are our worst nightmares in trading. When we're not rules-based, we're just kind of like the wild, wild west. We'll just kind of do whatever we want, and that's how we get into trouble. Now, I would say this, if you do want to have a rules-based, if you do want to have a close enough rule, just make a rule. Define what, quote, close enough is. Is it 10 pips? Is it 5 pips? Is it a certain percentage, right? Define it. And that way you can still have a quote unquote close enough rule. However, it is defined by rules. That way you don't give yourself the option to kind of sabotage yourself. But we do not hit the 786, so it is going to be a Gartley formation for me. And I'm looking at an X to A to B down here, excuse me, X to A to B up here, B to C, and I'm looking for a CD completion, which is going to be right up here. I think I measured that a little bit wrong. I took my finger off the trigger. Let me just do that again here. Restart that. So X to A to B, B to C, right down here. We did spike a little bit lower, and a CD completion right up here for a very deep Gartley pattern. And what I mean by deep is that because our B retracement retraced so deep to that 786, what it does is it gives us a very high completion point, at least per how I trade Gartley patterns, which is good because, as you can see by the little color boxes on the right side of your screen, it lessens my risk and it gives me more reward, which is something that I like. I like small risk. I like big reward. Hey, that's just my thing. What can I say? Now, what we also have here is another potential Gartley pattern setting up. And if we take a look at, I just forgot what I want to do here. If we take a look here, let's just take my Fibonacci extension out. Give me a second to do this. Yep. We're going to have another pattern formation setting up, and it's going to look like this. Our A leg is going to be our new X leg. This is going to be our X to A. This is going to be our A to B. This is going to be our B to C. And our CD completion is going to be right down here at 147.18. So I mentioned earlier that I like to take trades not in the middle, but at the swings. And what I love about these type of setups is that, right, of that recent move, kind of that up-down move we saw in the market on the daily where the price action spiked up and then it spiked all the way down, then it retraced back up, giving us that consolidation. This is my first swing up here, my highest swing. This is my lowest swing right down here. And you can see what I'm doing is I'm setting myself up for trading opportunities no matter what swing we come to. I don't necessarily care what happens in the middle here. You know, so there may be a smaller advanced pattern formation on a lower time frame, which I would take if it happened. But bigger picture, I'm looking to sell at previous structure resistance at the top. I'm looking to buy at previous structure support at the bottom. I don't really care which one gets hit. I'm a trader, not an investor. So I'm more like a mercenary. I just look for opportunities. But I've set myself up so no matter which way the market goes, I know exactly what I'm doing. I know exactly where and how I'm getting involved. And now my job is simple. I just have to wait. I don't have to tell the market to go one way or the other. I just wait till the market hits that level, and then I involve myself in the trade. So 2 trading opportunities this week. Took you guys to a handful of opportunities: advanced pattern formations, trend continuation type trades, breakout trades, give you guys a little bit of a lesson about fundamentals and how they affect the market. So I hope you guys enjoyed it. If you did, there's an easy way to show me. There's 4 easy ways to show me. In fact, 1, hit that like button on the bottom right of that video. It takes a second, but it does me wonders for growing the YouTube channel. Also, leave me a comment. Let me know what you thought. Let me know about your analysis on it, whether you have the same analysis, different analysis, questions, comments, whatever you want to leave. Even if it's just a thumbs up emoji, that's fine. And then please share this video, right? If you're on social media, right, the Twitter, Facebook, Instagram, LinkedIn, wherever you're at, share this video with a trading buddy of yours. I can't tell you how many traders that we've impacted that have found ourselves, that is our stuff, that have found our sites and have gone on to become independent, consistently profitable traders, all because they saw a random person retweet it. So that is a massive help. Please do that. And of course, if you're interested in spending more time with us in a more educational environment than just here on YouTube, a place where you can actually interact with us, trading coaches, make sure you try out that 14-day trial over at tier1trading.com. There's no commitment. There's no auto bill, anything like that. After your 14 days, you just lose access to training courses. You lose access to the software. You lose access to the community network and the live room, right? Just goes away. You don't have to worry about it. You don't have to check your credit card and remember to cancel or anything like that. So I'll see you guys on the platform. I'll see you guys, premium members. I'll see you guys in the Monday Q&A. I hope you guys have a good weekend. And until next time, plan your trade, trade your plan. Take care.